Peter Lynch's core message in this chapter is that there is no single perfect moment to buy or sell stocks, despite how much time investors spend worrying about timing. The right time to buy a stock is when you have done your homework, understand the business, and believe you are paying a reasonable price for what the company can earn in the future. That said, Lynch does point out that there are certain periods when good buying opportunities tend to appear more often than usual. One such period is toward the end of the calendar year, when investors engage in tax loss selling. During the autumn months, individuals and institutions often sell losing positions to offset capital gains or to clean up their portfolios before year-end reporting. This selling pressure can push prices down well below what the underlying business is worth. Low-priced stocks are especially vulnerable during this time, since margin rules and institutional constraints often force additional selling. Lynch suggests that investors who keep a watch list of solid companies they would like to own can often find bargains during these months, simply because others are selling for reasons unrelated to business performance. Another fertile time for buying is during broad market crashes or severe corrections. Lynch points to the stock market crash of 1987 as a powerful example. During that collapse, many financially strong and profitable companies were sold off indiscriminately, even though their long-term prospects had not changed. Professional investors were often frozen by fear, regulations, or career risk, while individual investors who stayed calm and focused on fundamentals could buy excellent businesses at deeply discounted prices. Lynch emphasizes that true market panics, while emotionally difficult, are among the best times to invest for those who are prepared. When it comes to selling, Lynch is especially cautious. He admits openly that he has sold many great stocks too early, often because of outside noise rather than changes in the business itself. He describes how investors are frequently influenced by commentators, analysts, or market rumors, all of whom are eager to tell you when to buy and just as eager to tell you when to sell. This constant stream of opinions can lead investors to abandon winning stocks prematurely. Lynch's advice is simple: return to the original reason you bought the stock and ask whether that story has changed. For slow-growing companies, which are typically owned for their dividends, selling makes sense if the dividend becomes unsafe or if the company's financial health deteriorates. Warning signs include declining market share, excessive debt, repeated acquisitions unrelated to the core business, or a dividend payout so high that even a modest downturn could force a cut. If the income stream is no longer dependable, the main reason for owning the stock has disappeared. Stalwart companies, which are large, established businesses, tend to provide steady but unspectacular returns. Lynch suggests selling these stocks when the price gets far ahead of realistic earnings growth. If the price-to-earnings ratio rises well above its historical range without a clear reason, or if management embarks on ill-advised diversification efforts that dilute profitability, it may be time to move on. He also advises investors to examine how these companies have performed during past recessions, since true stalwarts tend to hold up better during economic stress. Cyclical stocks require special care because their fortunes rise and fall with economic cycles. Lynch notes that the best time to sell a cyclical stock is usually when business conditions are still strong, but signs of excess are beginning to appear. Rising inventories, falling commodity prices, new competitors entering the market, or heavy capital spending late in the cycle can all signal trouble ahead. He uses the automobile industry as an example, explaining that while downturns are inevitable, recoveries are just as predictable. The challenge lies not in identifying that a cycle exists, but in recognizing when it is nearing its peak. Fast-growing companies are often the most exciting investments, but they also demand vigilance. Lynch suggests selling when growth begins to slow in a meaningful way. This might show up as fewer new store openings, declining same-store sales, or products that no longer capture consumer enthusiasm. He is particularly wary when fast growers become extremely popular with institutions and analysts, driving valuations to unsustainable levels. A slowdown in growth, especially for companies dependent on one-time product sales rather than repeat customers, can cause earnings and stock prices to collapse quickly. Turnaround stocks are owned for a very specific reason: the expectation that a struggling company will recover. Once that recovery has clearly occurred, the stock often belongs in a different category and should be reevaluated. Lynch stresses that investors should sell turnarounds after the turnaround is complete, not after the stock becomes expensive again. He cites examples such as Lockheed and Texas Instruments, where exiting unprofitable divisions transformed earnings dramatically. At the same time, he warns that turnarounds can fail if debt remains overwhelming or if management dilutes shareholders by issuing too many new shares. Asset plays are companies whose stock prices do not reflect the true value of their assets. In these cases, Selling usually makes sense once those assets are recognized or unlocked, often through a takeover, restructuring, or activist involvement. Lynch cautions that asset plays can lose their appeal if management takes on new debt, sells assets cheaply, or if changes in tax or accounting rules reduce their value. Throughout the chapter, Lynch warns investors against reacting to what he calls the drumbeat of market news. Headlines about interest rates, currencies, oil prices, or economic indicators often dominate financial media, but they may have little relevance to the specific companies you own. The key question is always whether new information materially affects the long-term prospects of the business. If it does not, then it should not drive your decision to sell. Ultimately, Lynch's guiding principle is consistent from beginning to end. Sell when the original story has changed. If the reasons you bought a stock are no longer valid, then selling is logical. But if the business continues to perform as expected and the valuation remains reasonable, there is often no reason to sell simply because the stock price has risen. Many of the greatest investment returns come from holding successful companies far longer than feels comfortable. His final reminder is one of patience. Great stocks rarely deliver their full potential in a straight line, and investors who constantly second-guess themselves often miss the biggest gains. By focusing on fundamentals, ignoring short-term noise, and revisiting the original investment thesis regularly, investors give themselves the best chance to benefit from long-term compounding.